What's up everybody? Welcome back to RoyalBluFX. In today's video, we're going to talk about why supply and demand is worthless. If you're new to the channel, go ahead and please subscribe to this channel right now because we always give out free content, guys. And we've already seen so many of you guys already buying the course. Thank you so much. I am so happy to come in and actually be your teacher. If you guys want to learn how to trade just like us, go ahead and DM us right now on Instagram to ask us about payment options, and we'll send you the link to our course right away. Also, guys, I do want to mention that the course was $1,300, but now it's $799. That is $600 less from the original price. So let's begin with this video. All right, so here is why supply and demand is worthless. Now, I know this is a sort of a fish baity title, but bear with me. I really want you guys to see what I'm about to show you and why you should understand supply and demand is worthless if you don't know this one key factor. Okay, now I'm going to just get the cat out of the bag right away, but the only way supply and demand can be worth it or is valid and is good to trade is only when there is liquidity inside supply and demand. Now, let me just show you an example quickly to show you how people look at supply and demand versus supply and demand with liquidity. Okay, so the first example is this. You can see prices are going bullish. In this scenario here, a lot of traders out there, including myself, have actually been caught in the trap of looking at supply and demand where you see a low and a high, a low and a high, right? You can also see it bearish, of course, but we don't need to do the bearish because it's just the opposite, right? So supply and demand is looked at where we have a low in the market, a break of structure, a high, right, another low created, right, and another high. So it's just creating order flow in the market. Essentially, you're taught as a trader to look for, swing lows, swing highs, swing lows, swing highs, higher lows, higher highs, higher lows, right? So that's all good. But as we all know in trading one sort of strategy and or looking at one concept isn't enough in trading. We all know that, okay? You need to incorporate other methods in there, okay? That could be whatever you want here from here. Liquidity, obviously, break and retests, SMC strategies, ICT strategies, whatever it is. But supply and demand should not just be traded alone by itself. And we all know this, right? Because there's a lot of things that happen inside the market, inside each high and each low, each impulse, right? So you and I were taught, right, highs and lows, right? You buy low here, you sell high here, you buy low here, sell high here, right? However, I'm about to show you another concept, a new concept. It's not really a new concept. However, I'm pretty sure the people that are following me and actually have seen the journey that I've been through when teaching everybody based on supply and demand and other variations, obviously, other strategies. The way we see the market is in this way. Supply and demand goes like this. There's a low created, right? There can be this, right, internal structure, right? Price runs, comes right back down, and then runs back up. Right? Now, it's not going to be this smooth, obviously. It's not going to be a playbook, simple playbook strategy like this, although textbook, right? Although it can be. But right here, the two differences between this here, this and this, is that each low and each high is created, but there's no liquidity inside, right? You can see there's no liquidity here, but between this swing low and this swing high, there is liquidity, right? So I'm more prone to trading liquidity, supply and demand versus no liquidity of these supply and demand zones, right? So I can't just look at a swing low when a swing low is created and price breaks the structure, right? And then coming back down to mitigate. I can't just assume that this is my next buy, right? Because this is a swing low, because this low took out liquidity. And I'll show you right now in another little example right now. So let's go here, and this is what I'm talking about. When you do have a swing low created. It has to take out liquidity. Price then runs. You can't just assume when price comes back to your demand zone to start buying immediately. Okay. This is what we called a smart money trap, SMC trap, which we'll talk about later in this video. But stay with me for instance. I want to talk to you about this a little more. Now, why is this an SMC trap? It's because there's no liquidity that was created in here, although you can call these little impulsive moves as liquidity, which it is, but it's not liquidity that you can physically see in here. Like I'm talking about something that's meaningful, big, and so one of the reasons why you can't assume to buy here is because when there is no liquidity, you want liquidity to create. So let's begin. When there's buying pressure coming in like this, then price coming back into this demand zone, taking out this low, this is already considered liquidity. This is an inducement, okay? Then you can safely take the entry after the sweep, take the entry to ride the market bullish. Okay, this is just one of many concepts that we do. However, liquidity must be present. Now, just so you guys can see what I see first before, excuse me, let me rephrase that. I'll show you what I see first rather than what I used to see first. Okay, so a lot of traders, again, see supply and demand. Essentially, all they're looking for is a low and a high, right? And you're just taught to look at supply and demand zones. In this case, I'm not looking at supply and demand zones first. What I'm looking at for first, okay, put as priority, is liquidity first. Now, this helps me indicate when there isn't liquidity, there's a high probable chance the price is going to sweep it, and then we can match our supply and demand zones with the liquidity that's provided, okay? So let me explain. Right here, this is an inducement. Here's a demand zone. Let's make this demand zone kind of close to this inducement here, okay? And we had this low swept, okay? And then we have, this is the demand zone right here. Okay, demand zone can even be like this. It doesn't really matter. You just need to understand the concept. Once I see liquidity, then I can apply my demand in my supply zones. Okay, both of them are swing highs and swing lows. So this is considered a swing low because we took out the liquidity and we chopped. This is considered a swing high because it took out liquidity and it also chopped. Okay, so this is what we call a confirmed range. Okay, when you see this, this is considered a range. And it's considered a range because it is the range between this low and this high, right? Between this low and this high, what you're looking to be trading from. Okay, that's your range. So this helps me to identify and confirm that not only is liquidity swept, but also our supply or demand in this case right here is also mitigated, which means we can safely take entries here to continue price bullish, to take price to the next move, right? This is how it's done. So there's many concepts, but I'll just show you a few in this meaningful example here so you guys can play along and watch. And we're going to go into a live chart example. So let's say again, price comes here, it sweeps, we buy, right? Once price goes up, right? Price can do something like this, right? Then price runs again, right? Now price comes back in, right? Here's where smart money trap is, the SMC trap. Price comes below, mitigates a demand zone, right? This is where you and I would be ready. However, I'm already looking at liquidity first. Okay, look at liquidity first before you see the supply and demand zones. Now this is a lot. This is really helpful for me. I don't know about you guys. You guys should go and see this for yourself, obviously, and test this out on your own, right? Because we know the markets are. We know the markets. Anybody can see the markets in their own variation, right? So I just spotted liquidity right there. I drew my eyes down to the nearest demand zone, and it has to be a swing low. And then I can see a low here, another high here, right? So now we have a swing low. It took out liquidity. Price ran up. Swing high took out external liquidity. This swing high comes down to take out internal liquidity. So we have a chalk. External liquidity swept, chalk right here, price coming bearish, mitigating a demand zone. And you and I are expecting to look for prices to run bullish. Okay? Just like this. Okay? Something like that. Now here's another example. Let's go. Let's just do this, actually. There's really no right or wrong way to draw this, as long as you understand the concept, of course. Let's go to the left here a bit. Okay. So let's say price broke the next high, right? And then now we're going to look for prices to run bearish again. Because what are we doing here? We are following order flow, but the only reason why we're following the order flow is because there is liquidity swept. We identified the liquidity, right? Let's say price comes down to the demand right now. Are you going to be looking to buy? Is there any noticeable liquidity inside between this low and this high? There is a swing low. We can see that, right? There's a swing low here. I don't know what that is. It's just a high, actually. There's no swing high created yet. Okay. So there isn't really anything in here, okay? So what my expectations here is to wait for liquidity. So how do I wait for liquidity? What do I do? I mean, obviously I sit on my two hands, but we can either expect price to move bullish here, right? It could do anything. It could even bounce here a couple times, right? Maybe 3 times, right? Just like this. Then you see the liquidity. We still have a swing low. Once price comes in, sweeps liquidity, it can run up, right? That could happen. Let's look at another example. Here's the last example I'm going to show you guys. Let's just draw the rest of this out here. Okay, price runs up, takes out this high, right? Now, again, price comes back down. Here's a demand zone. Are we ready to buy here? All right? There is no liquidity, no internal liquidity. So what do? I have to look for liquidity. So far, I see a bunch of liquidity creating here, right? So what does that mean? There can be buyers here to get faked out. This is where the SMC trap is, right? Price comes below, takes everybody out. Once that happens, right, that is liquidity. What do? You want to pair up the liquidity, right, with the given supply demand zone, right? So in this case, if it swept here, it actually came here and it mitigated this demand zone, right? So that is a swing low with all this liquidity. It's not just this liquidity, but you can see the whole trend line coming in, right? Just like that. This is all trend line liquidity. So price takes it out, right? Takes out that liquidity. And then what do you and I do? We wait for prices to, we can just pretty much just enter here or wait for your confirmation model, right? Wait for some sort of liquidity. Maybe there's more liquidity here, and then price runs up the other way. Okay, just like that, right? So notice how I just created supply and demand with liquidity. But supply and demand is also can be worthless if you don't trade the liquidity right. If you don't see liquidity, say for example, what I drew probably in the very first drawing, right? If you see a low and a high like this, price comes here, right, to demand. Don't be buying from these areas, right? These are just liquidity traps, right? Something like this, right? Look at this. We have a swing low, right? Price comes here, people are buying, and all of a sudden price comes knocking bearish like this, right? Taking everybody out, right? Because you're buying where the traps are, right? Let's say prices run bullish, right? What is this? This is liquidity. This high swept this, so that's a swing high. A bunch of liquidity swept. This high also broke this low right over here. So we can take a safe entry here, selling, right? Something like that, right? So the idea here is to always look for liquidity. And liquidity should be the first thing you prioritize before you prioritize supply and demand. It's 10 times more easier and quicker, right? Because we know that the markets don't, the theory goes like this: the markets don't have to come and mitigate a supply and demand zone. You can also see that the markets can also just create supply and demand, like so. Let me show you here, right? They can also create liquidity, right? But the markets don't have to come back to this demand at all. They could keep pumping bullish like this, right? Maybe come back down here, right? Sweep liquidity in here, internal liquidity, can take the markets bullish again, right? So while you're waiting and sitting here, waiting for buying to happen, right? When the markets, we expect the markets to come back here, the market's already doing something else already up here. Notice how I spotted liquidity first before supply and demand. Swept that liquidity, and now I know that I'm looking for buying pressure because I'm already looking for buys. So in this example here, liquidity swept, right? I would have looked for some confirmation internally in here on the lower time frame to take price bullish, just like that. Okay. One last thing I do want to mention is that when you're looking for supply and demand zones, or when you're trading the liquidity, right? Let's say we find liquidity, right? Price sweeps the low. We look to get in on the impulse. After liquidity swept, we look to take the liquidity impulse. That means this impulse here running up. And then now, when price comes back down, a lot of people are waiting for this, for demand, right here, to buy here from demand. I don't necessarily do that unless there's a bunch of liquidity sitting inside, because swing lows and swing highs can also be manipulated, okay? Prices could just do this, manipulate the buyers here, takes out the swing low, and again, we have another price moving up just like this, right? Just like that. So let's go into a live chart example right now just to show you guys how this works again, taking you a little step by step. Let's cut this here. Let's go here. All right, so let's just focus on this here. I always go on the daily or the weekly to find out what the market's doing. Let's just talk about this. Since we're on the daily right now, I can already spot liquidity. Notice how if we were here at that point in time, let's go right here. Okay, this is kind of a nice example. Price comes down. It doesn't take out liquidity, okay? This high did not take out liquidity. It just filled in an imbalance, right? Filled in the fair value gap. Not all of it, most of it, right? But this isn't the supply. This is not a swing. Oh, well, actually it is. Actually, it is a swing low. Excuse me. It took out this. So price came down, went up, took out that low. This becomes a swing low. So this is a confirmed swing low here. Let's focus our attention on this. Price runs up, right? Now, when price runs up, you can automatically see that we swept here, ran. Price left more liquidity here. You can see price also swept here. So this becomes a new swing low, right? A new swing low, a swing low. We now need to wait for the swing high to create. That means we'd want for price to come back down here. Okay, now the price comes here. It's not fully mitigated yet. People are already automatically buying here. Now, I don't do that personally, right? We want for price to come and sweep some sort of low, right? Internal liquidity. But there are people that buy this, right? Just like this. You can see how fast price went up. It didn't actually break the high. These are the first buyers in, right? That means There isn't liquidity in here, so therefore I can't buy. Now this I would look to buy here, but this is more an advanced tactic. We have what's called a hidden low right here. So if you use your line chart, you can see that right here. So that's our hidden low. So we could look to buy in here on the lower time frame to push price up. Let's continue though. I don't want to, I don't want to show you this exactly. Okay, there we go. Notice what happened here. We just had, I saw this liquidity, right? There's your swing low. There is your liquidity. Okay. Now, I spot liquidity first before I did supply and demand. Now, this is a very interesting thing here because I want to show you this. This is an internal swing low. This is the external swing low. But I want you to look over here on my crosshairs. Look to the right. You see a wick taking out the swing low too, right? This is why supply and demand can be worthless. But if you're spotting supply and demand and you're just entering like this, right, to hold it up there, you would have already been out, right? Price would have taken your sell stops, including these guys, right? So this would be irrelevant. But you might be saying, yeah, but RoyalBluFX, what about this? You did say there's a buy here. Yes, but we're not going to talk about TPs. I mean, I would have TP'd the supply zone actually right here. And being that this is the daily, we could look to target this supply as the target. That's the nearest supply. Okay, so we can look for a chalk boss in here and look for price to rise. But here is where it's important on the daily. Just looking at this, right? We swept this. Now, it didn't respect the swing low, which is fine because what did I mention to you in the drawings? That swing lows and swing highs can also be manipulated, okay? So your first job as a trader is to look for liquidity first because that is the driver of the market, okay? So we have the liquidity swept, and then you can go down on your lower time frames, and we trade the session. So we would look for the session of the day when it opens, right? We trade New York, and we're on the US tech, so we'll only be trading New York here. From this low to this high, you can see there's a swing high and a low. And a swing, it's not a swing low, but it's a swing high and a low. Swing high would create when price chalks here, and actually price comes back. However, we'll trade before the change of character actually happens, okay? Because a lot of traders wait for this high to be broken, right? Then they wait for price to come back, maybe even trade the next day and then take price bullish. But we trade here and now when the market opens. So here, automatically, I can already see there's a bunch of liquidity sitting here. And then, excuse me, guys, there's a bunch of motorcycles going by. I have my window open, but hope you guys can hear me. A bunch of liquidity is set here. And now we can look for an entry. We can pair up this entry with the demand zone right over here. Right here. Okay? So there's your nearest demand zone, right? That's your swing low that took out all this liquidity, right? Ran up, came back down, took out the liquidity, and entered. So you could have safely entered here. You might think, yeah, but isn't this aggressive? It's not aggressive unless you know where the market direction is. Okay? We had confirmation. We had a liquidity first. Then I matched our swing lows. Okay, and this is actually a swing high here. So my bad. This is an external swing high. This is a swing low because this swing low went up and broke this high. This is a swing high. It chalked. It took out liquidity. It chalked. So this is a swing high, swing low. We also have a swing low from here. It's sharing a swing high here. You can see this low chalked here. We have a swing high chalking here. Right? It took out liquidity also to the left. Right over here. You can see that it took out that candle right there. So that is a swing high, right? So this would have been a safe entry, right? This is how you guys do it, right? So notice I didn't look for a supply and demand. I just look for liquidity first. Let's continue because we know we're looking for buying opportunities now here. We're going to wait for the next. You can trade London if you want, but I do New York on this all the time. Okay, this is very interesting. Here's a bunch of liquidity. We got swept here. Okay, notice how I'm looking liquidity first, not supply and demand. A lot of you would probably be like, okay, well, there's a break here, so I guess this is my next buy right here, right? That's my demand zone, right? That's what you would do. But notice what price does. It doesn't even come here. A lot of you may translate this as, oh, yeah, but isn't it inducing? Sure, you can call it inducing, whatever. It's totally fine. But when price sweeps here, in here, you would go on a lower time frames and look for your demand zone right there. So that would be your demand zone, right? When price sweeps liquidity, go and look for your demand zone, which is right down here. This would have been your buy on London to go bullish, right? Just like that. Vice versa. If you look where London came down from, you can see we had a bunch of liquidity sitting here. It was right here and here. That's your order block. That's your supply zone, right? Because that supply zone took out this high liquidity. That's your swing high, right? You got the 3 candle formation. That means you got 1, 2, 3. That's your 3 candle formation. And then you have your sweep here. That's your swing high. We want price to come back up here to sell it. So in this case, the order block is this supply, this high right here. So you could trade away from here too, right? Simultaneously trade this bullish as well. Okay. So let's wait for New York. There's multiple things that happen. I can actually see on a lower time frame. So I'm not going to pretend like I don't see it because I do see it. This is an inducement right here. Right, so I look for inducement. I will match that now with a supply demand zone. This is out here. Okay, there's actually 2 inducement, so this would be the order block here. And you can also see this here. Let me just kind of make this bigger for you guys to see. Right here, there is a bunch of liquidity as well, right there, right? So that means liquidity. There must have been a breaker block in here. When the open happened, you could have happily been able to enter here to buy into at least a near supply zone. We're on the 10 minutes. Obviously, if we're down on the lower time frame, you'd be able to get a better view of this, right? Like this. Let's look at this. Just like this, right? So liquidity was swept, price comes in, find the nearest order block or supply zone, and this is your entry. That would be your entry. Boom, right? Same thing with this, inducement, demand zone, buy, right? So let's continue here. We just created more liquidity here. This is inducement, right? Let's see. Okay, here's your smart money right here. Now this is very interesting because this induced. So there are interested buyers in here, right? However, this is a high probable chance because you can see this is a high and a low. That's inducement, right? So let's see what happens right here. This one failed. All right. That's probably because we have the direction incorrect. Actually, we do, because this is a supply zone. We took out all this high. Market should be running bearish. So that is my fault on that one. Let's continue here. Let's catch another one and show you another example. Let's go into the next session. Let's go on the 15-minute. And let's make this go faster a bit. Okay, I went a bit too fast. Okay, so clearly off the bat, I can already see we have liquidity here. Put that to the right, that line. And the order block is right here. Right there. So this would be your buy. It would be your buy because all this is liquidity. This is inducement. and this would be your buy. This is the whole demand zone, right? Next day comes in, we see more liquidity being swept. Run down on your lower time frame to look for entries, right? So again, in this case, I don't see any supply zones that could happen. Supply or demand zones don't always have to appear, although this is reacting off of just pure imbalance, which is totally fine, right? You have your change of character here, right? Price sweeps liquidity, right? Comes back to your demand zone here, and you trade away from liquidity, just like that, right? Targeting the nearest supply zone, just like that. So yeah, the more you do this, right? Notice if I just say to myself, let's look for supply and demand zones. Actually, let's just play this quickly so I can show you guys how this supply and demands don't always or don't work accordingly the right way, right? They're worthless if you don't have liquidity in them. So let me just show you. Okay, let's play this out. Hold on. Okay, let's just picture this demand zone. Right, because price is going bullish, we can put this here, right? Let's see if this works out. Notice what happened. Price ran through it, right? Now in here, we don't have any liquidity. Excuse me, actually, right over here, we just swept all this liquidity. So that means price is falling bearish. But if I bought based on the demand zone, we had a sweep here. Right, that's the demand zone. So doesn't that mean that this demand zone should hold and we should buy from? No, right? Because there was no confirmation in here. You had inducement, price came in below, swept. More inducement, price came in, but this time it failed. Now I know the reason as to why. This one actually did have some liquidity. So if you look to the far left, we had a bunch of more liquidity right here. Feel the imbalance and ran bearish. Let's continue here. Let's see if there's any more liquidity here. Excuse me, supply and demand zones. Oh, excuse me, right here. Supply zones here. People are trying to sell from here. Right? There is liquidity here, but this one didn't work. Right? Because we just had this side come in, take out all this liquidity. And went below this wick right there. So you need to be looking for liquidity again. Let's mark this demand zone because now I'm really serious about this. I'm going to be buying from here, right? Let's see. Oh, price. Okay, there we go. Price came to your demand zone. Lock. No, actually, guys, there is a bunch of liquidity here. You can see that. So this would be valid, right? So this would be a valid buy. There we go. Okay. Another one where I would look at this as my demand zone, honestly. So price wouldn't have reached my demand zone, right? But we saw a bunch of liquidity. You could have reacted already once it sweeps, react in it to take part of the market. Anyway, guys, I hope you guys see what I'm doing here. I hope I showed you something. Hope you guys were interested enough. Until then, guys, I will see you in the next video.